Welcome back to Throwback Thursday. Today we're diving into the 2008 financial crisis, a meltdown that shook the global economy and left a lasting impact. We'll break down what happened, who played a part, and the lessons we can still learn today. The 2008 financial crisis started with the US housing market collapsing, and it quickly spiraled into a global recession. Banks failed, stock markets tanked, and millions of people lost their jobs and homes. So how did the 2008 financial crisis unfold? You see, it was a combination of bad decisions, risky practices, and a lack of oversight. Let's break it down more. Risky lending practices. Banks started giving out what are called subprime mortgages, basically loans to people with low credit scores or unstable incomes. Why? Because these loans came with higher interest rates, which meant more profit for the banks. But they were also much riskier, and as more people struggled to pay, cracks in the system started to show. The housing bubble. With access to loans, more people jumped into the housing market, driving prices through the roof. Everyone thought house prices would keep rising, so they kept buying, even if it meant stretching their finances razor thin. But when the bubble popped and the prices plummeted, people were left with homes worth less than their actual mortgages. This led to a wave of defaults. Mortgage-backed securities. Most banks did not want to hold on to these risky loans by themselves, so they bundled them together into products called mortgage-backed securities and sold them to investors. These were marketed as safe investments, but in reality, they were filled with those high-risk loans mentioned before. Leverage and complexity. To make matters worse, financial institutions borrowed heavily using leverage to invest in these products. This made the banks vulnerable. When defaults rose, their losses were magnified and the entire system started to collapse. Lack of oversight. Finally, weak regulation allowed all of this to go unchecked. Complex products like mortgage-backed securities and credit default swaps flew under the radar, and no one really stepped in to stop the risky behavior before it was too late. So what did we learn? Understand risks. Don't rely on labels like safe. Always dig deeper before investing. Beware of bubbles. Rising prices don't last forever. Over-optimism creates bubbles that can eventually burst. Diversify. Those who were heavily invested in housing or financial stock lost the most. While diversification doesn't eliminate risk, it helps reduce it. And leverage is risky. Borrowing to invest can magnify losses. Be cautious of debt. The 2008 financial crisis exposed the dangers of risky practices and lack of transparency. It led to stricter rules and better oversight to make the financial system more stable. These changes are a reminder to stay informed and be cautious. If you found this helpful, hit that like button and subscribe. See you next week for another Throwback Thursday. And again, this video is meant for general informational purposes only, and it is not financial advice. Always consult a qualified professional for your financial decisions.